Hi everybody. Welcome back to our series of video lectures on the statement of cash flows. In the prior 3 videos, we prepared statements of cash flows for expressions using both the direct and indirect methods. Expressions was an extremely simple example. So in this video, we'll prepare a statement of cash flows for a little bit more company with a little bit more complexity. We will use the indirect method to prepare the statement of cash flows for Acct company. As always, I strongly recommend that you download and print the PDF version of the worksheet or download the Excel workbook so you can follow along and practice with the video. In prior video lectures for Chapter 12, we discussed the need for 4 pieces of information before you have everything you need to prepare a statement of cash flows. You need comparative balance sheets. You need the balance sheet at the end of the prior accounting period and the balance sheet at the end of the current accounting period. When 2 balance sheets are laid side by side, they're referred to as comparative balance sheets. And I have subtracted the 2 balances for you. So for instance, accounts receivable at the end of last year was $25,860. At the end of this year, it was $20,222. So there was a decrease in accounts receivable during the year of a little over $5,600. If the number is positive, the account balance increased from last year to this year. If the number is negative, the account balance decreased from last year to this year. I don't think your homework does this for you. You're going to have to do some subtractions to complete your homework. So we have the 2 balance sheets. We also need the current year income statement, which we have right here. And you need some other information, additional information, which we have right here. You should have a flag on page 469 of your textbook so that you can refer to Company for the format of this cash flow statement. We need a 3-line heading, which is almost identical to the one for the income statement. Instead of income statement, it says statement of cash flows. We need these 3 lines. We start out always with cash flows from operating activities. Then we say net income. Then we say adjustments to reconcile net income to net cash provided by operating activities. Then we say income statement items not affecting cash. Why don't you go ahead and pause the video, complete your cash flows statement through this spot right here and drop in Satt's income for the year. When you finish, come back, start your video again to check your work. So 3-line header, Satt Company Statement of Cash Flows for year ended December 31st, 20X2, cash flows from operating activities, net income, $202,767, and then the words, adjustments to reconcile net income to net cash provided by operating activities, income statement items not affecting cash. Going back to Satt's information, this is where I got the net income number, obviously, and the date of my cash flow statement. So we need to know if there are any items on this income statement that had absolutely nothing to do and never will have anything to do with cash. Sales, we receive cash from our customers. Cost of goods sold, we pay cash for our inventory. Other expenses, we pay cash for those. Income taxes, we certainly pay cash for those. So everything here except depreciation have some component of receipt or payment of cash, but depreciation expense is never paid for with cash. The journal entry is always debit depreciation expense, credit accumulated depreciation. So the only income statement item not affecting cash is depreciation expense. It was deducted from our revenue to arrive at net income, so we have to add it back in if we're converting to the cash basis. So income statement items not affecting cash, depreciation expense, and SATU's depreciation expense off the income statement was $15,700. What happens next? Next, we need changes in current assets and current liabilities. So I'm going to write that line in there. Then we're going to talk about whether the change should increase net income or decrease net income. And there's a little bit of a trick for remembering whether a change is going to increase or decrease net income, and I'll show you that trick in just a moment. You should also have flagged page 455 in your textbook so that you can frequently refer back to Exhibit 12.4. We're creating the operating section of the cash flow statement, and what flows into the operating section are changes in current assets and changes in current liabilities. So let's take a look at our balance sheet. Let's identify what assets here are current assets and what liabilities are current liabilities. Cash is certainly a current asset, but we don't put cash on our statement of cash flows because the whole purpose of the statement of cash flows is to calculate the change in cash, and that happens at the bottom of the cash flow statement. So we're going to ignore cash for right now. Accounts receivable is a current asset. Merchandise inventory is a current asset, but equipment is not. So we have two current assets, and we need to know how the changes in those two current assets are going to affect net income in our statement of cash flows. Looking at the liability section, accounts payable is current and income taxes payable is current. So we also have two current liability accounts, and here are the changes in those accounts, and we need to know how those changes affect our net income in converting from the accrual basis to the cash basis on our statement of cash flows. So I have a little trick for you. Some tricks to remember whether a change in a current asset or a current liability should increase or decrease net income on the statement of cash flows. A change in a current asset will have the opposite effect on net income. And I find that if I pronounce opposite with a really bad accent, and I say, a change will have an apposite effect, then apposite sounds like it starts with the letter A. So to help you remember, say the word opposite as apposite, and think that both assets and apposite start with an A. And that will remind you that a change in a current asset account has the opposite effect. So you're going to do the opposite to net income. If the balance in a current asset account increases, you're going to do the opposite and decrease net income. If a change in a current asset account decreases, you're going to do the opposite and increase net income. So an increase in a current asset account will decrease net income, the opposite, and a decrease in a current asset account will increase net income, the opposite. Let's do that to our two current asset accounts. Accounts receivable decreased by $5,638. The effect on net income is going to be the opposite. We are going to say these exact words. Decrease in accounts receivable, $5,638. But the question is, do we add it to net income or subtract it from net income? And it's going to have the opposite effect. So let's see how that works. Accounts receivable is a current asset. It's going to have the opposite effect on net income. So if this word says decrease, then add it back to net income. Increase net income, the opposite effect. Let's do the other current asset, which is merchandise inventory. Merchandise inventory increased during the year. So we will say these exact words, increase in merchandise inventory, and because it was an increase, we're going to subtract $25,347 from net income, the opposite. Increase in merchandise inventory. And that's exactly what it says here. This is an increase. Merchandise inventory was $140,000 and change. It's now over $165,000. Merchandise inventory increased by $25,347. And we say those exact words, increase in merchandise inventory. But then we subtract that increase because the effect of changes in current assets has the opposite effect on net income. Whereas a change in a current liability will have a direct effect or the same effect on net income. If the balance in a current liability account increases, then increase net income. If the balance in a current liability account decreases, then decrease net income. You only have the opposite effect for an asset. You have the same effect for a liability. We have two current liability accounts, and they both decreased. So we are going to say these literal words, literally. Decrease in accounts payable, $137,158, and we're going to put brackets around that. Decrease in income taxes payable, $4,000, and we're going to put brackets around that. Because changes in current liabilities have the same effect on net income. So decrease in accounts payable, $137,158, and decrease in income taxes payable, $4,000. And that should be the end of the cash flows from operating activities section. So we need then to calculate our net cash provided by operating activities because more cash came in than was paid out. So net cash provided by operating activities is $57,600. Notice the use of the columns. Just like on any financial statement, we use columns to facilitate the ease of reading the financial statement. It keeps it organized. These are not debits and credits. This is just a column of numbers that add up to that number. Also notice that, as in all financial statements as taught in this textbook, there's a dollar sign by the first number in a column and a dollar sign by the first number in this column. We'll use some more dollar signs and underlines, etc. as we get down towards the bottom of the statement of cash flows. In the meantime, I have underlined this right under the $4,000, as that underline means, reader, stop. We're going to do a mathematical equation with the numbers above this line, and then we're not going to use those numbers anymore. Well, we're getting kind of short on time, so I'm going to end this video. In the next video, we'll come back and we will continue with preparing the statement of cash flows for SAT2 company.